Hi class, a pleasant day to everyone. This is your prof again, Sir Dan, and we are going to continue the discussion on financial analysis and in particular financial ratio. We have learned the four categories of financial ratio, which are profitability ratio, liquidity ratio, operating ratio, and solvency ratio. And on the previous video, we discussed in details profitability ratio, liquidity ratio, and operating ratio. And on this video, our discussion will focus on solvency ratio. Okay? So what is solvency ratio and what are the types and uses of solvency ratio? Solvency ratio is the ability to manage all resources of the business and pay all long-term obligations. Stability ratio is that assets must be sufficient to meet long-term obligations. The types of solvency ratio are debt ratio. And debt ratio measures the portion of company assets that is financed by debt obligations to third parties. So here we are measuring what is the percentage of debt in relation to total assets. So debt ratio can also be computed using the formula 100% minus the equity ratio will give you the debt ratio. So again, class, debt ratio's formula is total liabilities over total assets. And the other type is equity ratio. Equity ratio determines the portion of total assets provided by equity. When we speak of equity, it means owner's contribution and the company's accumulated profits, the total of the two. Equity ratio can also be computed using the formula 100% minus debt ratio. Again, class, equity ratio, the formula is owner's capital N over total assets. Okay? Let us do the illustration. Oh, by the way, class, if we are speaking of a balanced financial structure, we should have a proportion of an equal proportion of debt ratio and equity ratio, meaning the ratio for both debt ratio and equity are close to each other. And if we are speaking of conservative position, our equity ratio should be higher than the debt ratio. And if we are speaking of aggressive position, then our debt ratio is higher than equity ratio. Aggressive position is quite a dangerous position, okay? Because it means that we are indebted, okay? The business is indebted. Okay, class. Let us illustrate solvency ratio or stability ratio. So again, the formula for that ratio is total liabilities over total assets. And our equity ratio, the formula is owner's capital N, which is the equity, over total assets. So class, in as much as we only need, we will be needing liabilities and assets and capital, so we will only need the statement of financial position, okay? So in this case, we can compute the debt ratio. The debt ratio is total liabilities for 2018. Debt ratio for 2018 is we have total liabilities of 300,000, okay, over total assets of 658. You can also use the total liabilities and equity, which is also 658. They are the same because it has to be balanced, okay? So our debt ratio is 45.59%, okay? And for our, here, 45.59, meaning 45.59% of the total assets came from third parties or from the debt. Okay? So for 2018 equity ratio, so we are now computing what is the percentage of this over total assets. So here our equity ratio is 358 over 658. So we will get a percentage of 54.41%. So the composition of our solvency ratio is our debt ratio of 45.59% and equity ratio 54.41%. So that will be a total of 100%. Okay? So for 2019, we will do the same. So here we are going to get what is the percentage of the debt in relation to total assets. So the debt ratio for 2019 is equivalent to 55.07%. Okay? We have to, if you are doing the mathematical calculation, you will get the decimal. So you need to translate that to in percentage by moving the decimal point 2 places on the right. Okay? And for 2019 equity ratio, so what is the percentage of this capital and over from total assets? So we will do the calculation for 2019, which will be 328 over 730. And doing the mathematical calculations, we will have 44.93%. So in this case, 44.93%. So we will again have a total of 100%. So what we are trying to say here is that 55.07% of our total assets is funded by obligations or liabilities, and 44.93% of our total asset is funded by the capital, which includes the profit generated by the business, accumulated profits. Okay, class, that is the end of our profitability ratio. And I hope that you are all in good condition and you will hear me again on the last topic on this module, which is the vertical and horizontal analysis. Okay, class, bye for now and stay safe.